You heard about Ripple XRP, number 3 cryptocurrency in terms of market cap value. But did you hear it is the number 1 threat to traditional banking systems? Today we will cover that question, and only if you stay until the end, you will be able to get a clear picture whether XRP can truly destroy banking systems as we know them. And if you don't know anything about world of cryptocurrencies, don't worry, because every video on Bitcoin Academy is 100% beginner friendly. So without wasting time, let's dive in. To truly understand how Ripple could dismantle modern banking systems, we must first clarify what Ripple and XRP actually are, because most people, even in crypto, get it wrong. Ripple is a private fintech company founded in 2012 with a mission to enable real-time global payments. XRP, on the other hand, is the native digital asset of the XRP ledger, an open-source, decentralized blockchain. While Ripple uses XRP in some of its solutions, the token exists independently of the company. The core idea behind Ripple's technology is that money should move as quickly and seamlessly as information, instantly, affordably, and without friction. And XRP plays a key role in that ecosystem by acting as a neutral bridge currency that can transfer value between any two fiat currencies, especially in places where liquidity is poor or banking infrastructure is weak. While other cryptocurrencies focus on decentralization or speculative investment, XRP was designed specifically for utility in the global financial system. This is not about replacing fiat money, but replacing the outdated rails it runs on. That's what makes it different, and that's where the threat begins. Because if XRP and the Ripple protocol succeed, entire layers of traditional finance, from correspondent banking to cross-border clearinghouses, become obsolete. The implications aren't just technological, they're structural, regulatory, and geopolitical. Ripple's goal isn't to destroy banks outright. It's to make them rethink their role in a world where middlemen aren't necessary anymore. And that is why XRP, despite constant legal and public controversy, continues to draw the attention of institutions, investors, and governments alike. It's not just a coin. It's a signal that the age of delayed, expensive money transfers is coming to an end. Before we understand Ripple's threat, we need to examine the target. The traditional banking system, particularly how it handles cross-border payments. Most global transfers today still rely on SWIFT, a messaging network developed in the 1970s. It doesn't actually move money. It just passes payment instructions between banks. The real transfer involves a complex chain of correspondent banks, each taking a fee and introducing delays. What should be a simple transaction, say sending $1,000 from the US to Nigeria, can take days, cost up to 10%, and arrive with unclear exchange rates and limited transparency. This isn't just inefficient, it's deeply exploitative, especially for low-income individuals and migrant workers who depend on remittances. The system is fragmented, expensive, and slow by design, not accident. Banks and clearinghouses profit from the delays, currency spreads, and compliance bottlenecks. This legacy infrastructure was never designed for real-time movement of money, and it shows. Even large corporate transfers are plagued by reconciliation errors, limited visibility, and pre-funded nostro-vostro accounts that lock up billions in capital. Ripple's founders saw this dysfunction and asked a radical question. What if money moved like data does on the internet? What if we removed the middlemen and just connected sender and receiver directly with cryptographic proof and consensus validation? XRP as a digital asset makes that possible by bridging currencies without needing banks in the middle. Traditional finance still holds political power, but its technological advantage is gone. Today, it's not about whether Ripple can replace SWIFT. It's about why SWIFT is still considered acceptable. The global economy has outgrown its banking infrastructure, and Ripple is exposing that reality to the world. With RippleNet, Ripple took a direct shot at one of banking's most entrenched strongholds: international payments. RippleNet is Ripple's enterprise-grade payment network that connects financial institutions directly, allowing them to send money across borders instantly, with end-to-end traceability and near-zero fees. Unlike traditional systems that rely on a string of correspondent banks, RippleNet connects parties through a unified protocol, removing delays at reducing failure points and eliminating excess costs. It's already in use by more than 300 financial institutions globally, from regional banks in Southeast Asia to larger players like Santander and PNC. But RippleNet becomes even more powerful when paired with XRP. Instead of needing pre-funded accounts around the world, a huge capital drain for banks, institutions can tap into XRP liquidity on demand. The transaction is instant. Convert from your local currency into XRP, move the XRP across borders in seconds, and convert it into the destination currency, all without touching a single legacy intermediary. This model not only speeds up transactions, it fundamentally rewrites how global liquidity works. Banks no longer need to maintain expensive dormant accounts in every region they operate. RippleNet isn't about replacing money, it's about replacing the plumbing beneath it. The real threat here isn't flashy headlines or token price speculation. It's quiet infrastructure adoption. RippleNet is already processing millions of dollars daily, and few outside the industry even realize it. That's by design. Ripple isn't trying to go viral. It's embedding itself quietly into the back end of global finance. If it succeeds, the financial system of tomorrow won't look very different on the surface, but underneath, it may be running on Ripple. Now that we've covered RippleNet, let's focus on the silent engine behind it, XRP. While RippleNet can operate without XRP, the magic really happens when XRP is used as the bridge currency for what Ripple calls On Demand Liquidity, ODL. Traditionally, for a bank to send money from one country to another, it must keep reserves, known as nostro accounts, in foreign banks. This ties up billions in capital and creates friction. ODL removes that need entirely. Here's how. A bank converts its local currency into XRP, sends it across the XRP ledger in a matter of seconds, and the receiving bank immediately converts the XRP into its local currency. No waiting, no foreign bank accounts, no intermediaries. This is why XRP isn't just another token. It's a liquidity solution for a problem banks have been tolerating for decades. And yet, very few traditional banks openly talk about XRP's role. Why? Because if XRP-based settlement becomes mainstream, it could reduce their power and eliminate their fees on foreign exchange and clearing. XRP decentralizes liquidity, and that's a direct threat to the legacy financial system that profits from centralization. Even today, many of the institutions using RippleNet keep XRP's involvement quiet, not wanting to trigger regulatory scrutiny or backlash from competitors. But behind closed doors, pilots and tests continue. Ripple's ODL volumes have been steadily rising, with growth across Asia-Pacific, Latin America, and the Middle East. What's at stake here isn't just a faster transaction, it's a reshuffling of how value moves globally. XRP introduces a world where anyone can transfer money instantly and cheaply without needing to ask a bank for permission. And the financial world knows it, which is exactly why it's treading so carefully around what XRP really represents. Here's something you rarely hear in public. Many banks aren't just watching Ripple, they're already working with it. Over the past few years, Ripple has quietly formed partnerships with more than 300 financial institutions across 40-plus countries. These include names like Santander, SBI Holdings, Tranglo, and Bank of America. Not exactly fringe startups. The appeal is simple. Ripple offers technology that lets these institutions cut settlement time from days to seconds, lower costs, and streamline compliance. But here's the twist. Many of these partnerships remain shrouded in NDAs or vague statements. Why? Because Ripple, and especially XRP, challenges the existing financial order. Banks are cautious not just because of regulation, but because openly embracing crypto infrastructure threatens their traditional revenue models. If Ripple can help them send money faster and cheaper, great. But admitting that XRP may eventually replace SWIFT or reduce the need for correspondent banking, that's a different story. Still, signs of adoption are everywhere. SBI Ripple Asia has launched multiple payment corridors in Japan and Southeast Asia. Tranglo is powering remittances across the Philippines and Malaysia using Ripple's tech. Even the UAE's central bank has tested Ripple for cross-border settlement. The real strategy? Quiet integration first, public rollout later. Once regulations are clearer and public sentiment catches up, Ripple isn't forcing change on the banks. It's inviting them to adapt, slowly, strategically, and without losing face. But make no mistake, the groundwork is being laid. If XRP-powered systems prove cheaper, faster, and safer than traditional rails, banks will eventually be forced to choose between profit margins and obsolescence. Right now, they're watching. Some are already building, and many more are preparing for a future that doesn't fully rely on legacy systems anymore. One of the biggest roadblocks to XRP's adoption came not from the tech world, but from a courtroom. In late 2020, the U.S. Securities and Exchange Commission, SEC, sued Ripple Labs, alleging that XRP was an unregistered security and that Ripple had conducted illegal sales. The lawsuit sent shockwaves through the crypto industry, with exchanges delisting XRP and investors pulling back. At the heart of the case was a fundamental question: is XRP a security or a currency? For nearly 3 years, this legal battle cast a shadow over Ripple's progress. Yet it also became a test case for crypto regulation as a whole. In mid-2023, Ripple scored a partial legal victory. A US judge ruled that XRP sales on public exchanges did not constitute securities offerings. This clarified that XRP could continue trading freely, and most exchanges relisted it shortly after. However, the case didn't fully resolve Ripple's legal status, especially regarding institutional sales. Still, the judgment was enough to restore investor confidence and reopen doors for expansion. For Ripple, it was vindication. For regulators, it was a signal that blanket crypto bans wouldn't hold up in court. But beyond the headlines, something deeper was happening. While the lawsuit delayed adoption, it also forced Ripple to expand globally, focusing on Europe, Asia, and the Middle East, where regulators were clearer and more crypto-friendly. That global push made Ripple less dependent on US policy, a strategic advantage that continues today. The SEC case slowed Ripple down, but it didn't stop it. And with legal clarity improving and partnerships increasing, it's becoming harder for critics to write XRP off as too risky. If anything, the lawsuit may have toughened Ripple, proving that this technology can endure regulatory storms and still emerge standing. Next, let's talk about the quiet fear behind closed banking doors. The rise of Ripple and XRP isn't just a technological shift, it's a threat to the control banks have held for decades. Traditional financial institutions have long operated as the gatekeepers of global money movement. Cross-border payments? They go through correspondent banks, SWIFT networks, and clearinghouses. Each layer adds time, cost, and control, all of which benefit the banks. XRP turns that model upside down. With On Demand Liquidity, ODL, there's no need for those middle layers. Liquidity is provided instantly through XRP's decentralized ledger, eliminating the need for Nostro accounts and making many traditional banking functions obsolete. That's why some banks are hesitant to publicly endorse or adopt XRP. It challenges their relevance. When a remittance from Japan to Mexico settles in seconds without any central clearing authority, what happens to the bank in the middle? It gets squeezed out. And that's exactly what's at stake. To make matters worse for traditional players, Ripple's tech is already being used by challenger institutions and fintech startups who don't mind bypassing the old system. For large banks, this isn't just about adopting a new technology. It's about deciding whether to let go of long-standing profit centers. But change is coming, whether they like it or not. Banks that fail to adapt may find themselves competing with newer, faster, and cheaper alternatives that don't rely on their networks. It's not that banks will disappear overnight. Many will evolve. But the ones pretending XRP doesn't matter, they're already losing. Ripple isn't here to ask for permission. It's here to offer a better way. And the smart institutions are starting to realize they have two choices: integrate the future or get left behind by it. As we dig deeper into XRP's disruptive potential, let's ask a bold question. Could XRP-based technology make traditional banking services completely obsolete? While that may sound extreme, the trajectory of Ripple's development makes the idea worth exploring. Let's start with what banks currently offer: currency exchange, remittances, clearing and settlement, cross-border payments, and in many cases, payroll processing. Now imagine each of those services executed faster, cheaper, and with less friction through decentralized infrastructure powered by XRP. That's exactly what Ripple is building. Ripple's on-demand liquidity already removes the need for pre-funded accounts and correspondent banks. That alone could eliminate entire layers of banking infrastructure. Payment processors using RippleNet can now move value directly between currencies using XRP, reducing delays and saving millions in fees. For smaller financial institutions or fintech startups, this means they can offer banking-like services without the overhead or legacy systems. And as more governments and businesses test CBDCs or stablecoins, XRP could serve as the universal bridge for converting and transferring between them. No central bank needed. That's not to say traditional banks will vanish, but their role could shrink dramatically. If XRP continues to evolve as a neutral, decentralized liquidity layer, it may become the invisible force powering financial services behind the scenes. Think of it like the internet. Most users don't know how TCP/IP works, but they rely on it daily. In a similar way, future users might not use XRP directly, but it could be the default settlement layer behind their banking apps, digital wallets, or payroll systems. So could XRP make banks obsolete? Not entirely, but it could make them optional. In a world of frictionless money movement, the old gatekeepers may find themselves standing in front of open doors. The question is, will they walk through them or get shut out? Next, we zoom out to the global level, because Ripple's vision isn't just about challenging commercial banks. It's about transforming how central banks and governments handle money, too. In recent years, central bank digital currencies, CBDCs, have become one of the hottest topics in finance. Over 100 countries are exploring or developing their own CBDCs, digital versions of national currencies backed by the state. The challenge? These digital currencies need to be interoperable across borders, secure, and fast. That's where Ripple enters the picture. Ripple has already formed partnerships and pilot programs with several governments and central banks. Its CBDC platform, built on a private version of the XRP ledger, allows countries to issue and manage their own CBDCs while still leveraging the same efficient tech that powers XRP. This positions Ripple as a neutral infrastructure provider in a space dominated by geopolitical competition. For example, countries that don't want to rely on US-based payment rails like SWIFT may see Ripple's tech as a secure alternative. But XRP's role in this equation is even more interesting. While central banks issue digital fiat, XRP can serve as a universal bridge asset, connecting incompatible CBDCs, enabling fast conversion, and avoiding the need for massive reserves or third-party clearinghouses. In essence, XRP becomes the glue that binds a fragmented digital financial system into something seamless. If successful, this could change how global finance works. Rather than banks or governments relying on clunky closed networks, they'd tap into open-source cryptographic infrastructure that doesn't discriminate based on politics, borders, or size. Ripple isn't promising to control CBDCs. It's offering tools to help them work together. And in that role, XRP could be the invisible engine behind a new kind of financial world, one that's faster, fairer, and more globally connected than anything we've seen before. Finally, let's confront the big question. Is XRP the end of banking as we know it? The answer isn't as simple as yes or no. But one thing is clear. Traditional banking will never be the same. Ripple's core mission isn't to destroy banks. It's to replace the outdated rails they run on. Still, that goal alone undermines much of the power banks hold today. In the past, you needed a bank for nearly every financial action, storing value, sending money, exchanging currencies, or paying bills. XRP threatens that necessity. With RippleNet enabling direct, real-time global payments and XRP providing instant liquidity, individuals and institutions alike now have access to financial infrastructure that rivals and in many cases outperforms what banks provide. The technology isn't hypothetical. It's already being used across dozens of corridors worldwide. Small financial firms, fintech apps, and even central banks are exploring how to plug into Ripple's network, often skipping legacy institutions altogether. But full disruption takes time. Banks are deeply embedded in regulatory systems, political frameworks, and cultural habits. Some will adapt, integrating Ripple's tech and reshaping themselves as agile service providers. Others may fade into irrelevance, clinging to models that no longer serve users efficiently. That's why this isn't about overnight collapse. It's about gradual transformation. Ripple doesn't need to kill banking. It only needs to offer a better alternative. The market will do the rest. So is this the end of traditional banking? Maybe not yet. But for the first time, there's a credible path to a post-bank financial system, one where individuals hold more power, transfers are instant and global, and money moves like data, fast, cheap, and without borders. Ripple and XRP might not eliminate banks, but they're already forcing them to evolve or risk becoming the fax machines of finance. And in that sense, the end has already begun. Let me congratulate you on making it this far. Now you know more than 95% of people regarding this topic. But don't stop here. You can keep building your knowledge by watching one of these 2 videos you see on the screen right now. In the financial world, information is power, and the more you know and understand, the higher your chances of success become. So, keep learning, keep exploring, and keep asking questions. Don't forget to like, subscribe, and leave a comment on today's video. Best of luck, and I'll see you in the next one.